Morning, team. Planty here, and it's a weekly preview of the 22nd of January 2024. So this would have been with you slightly earlier, but Storm Aisha got in the way, and I was euphoric. You'd have seen the Sheffield United hat. McBurney equalised in the 103rd minute. I'm absolutely flying and just about to press record, and boom, the power went, and that just increased my spend on the Domino's Pizza app because there was not a lot else we could do. No power. Anyway, let's crack on. Last week in the markets, but before we carry on, what the change of style for this week? I've done a weekly preview PDF which you can open, play along with this, or just watch the video. Just give you a slightly different feel. So I'm inside the PDF, and I'll jump into the charts later on. There are some charts included in the PDF. So anyway, last week economic data generally strong again. Rates continuing to push back, but it doesn't seem to be affecting the indices too much. We will have a look at something that we don't cover that you can't trade in it, but you need to know about it. The 10-year US Treasury yield, and that has been playing around with its 50-day moving average. Now, for the breakout that we're expecting in the weeks ahead, that yield needs to drop, and we'll have a look at the chart, and that is sort of suggesting it. Fed policymakers and the ECB people, either at Davos or not, generally pushed back, and the markets took it that way. But data points are fairly soft. Earnings reports look like we're at least muddling, if not better. The rate cuts are coming. It's just when. A slight delay being suggested. And we've obviously got a lot of geopolitics in the mix, but it doesn't seem to be having too much effect on oil. And we did mention that we'd look at that today, and I will do as this video progresses. So first thing to look at is that US Treasury yield that I mentioned. The 10-year very much looks like we had a topping out there towards the end of the year when the rally started, and that could equally be part of a long-term uptrend. So we're in a consolidation pause. Favorite setup, as we know. Let's look for equal legs, and that suggests we could be looking at 3% at some stage in the weeks and months ahead, which would really turbocharge the rally once we've got out of the way this little consolidator. So it's the one down consolidation, and there again, a 50-day moving average. Look at it; it always seems to have hung on to this, but this could be the decisive breakaway. To be advised, keep a look at that. So stock market, as I said, has been rallying. We started off retreating last week with the pushback data and the commentary. But Thursday onwards, I think really driven by Taiwan Semi, which is the global hub for all things Apple related, etc., etc. I think it's double whammy of the election going the way of the doves and the non-rolling over to China mix, along with great earnings. So that rekindled the tech spirits, and we were off to more records. But we're in a tug of war at the moment with the people who have the hand on the tiller of the rate cuts. We'll have to see who wins. But at the moment, it very much looks like Goldilocks is to the fore. But remember, it is December, which all this data is. They often are mixed because people are going on holiday. The real the ones that people are going to take notice of are the February data points, and they're coming up pretty soon. So stand by for some volatility, but anything that gets the rate cuts back on the agenda for being in March, again, we'll have an absolute zoom to new highs. This week, the main focus outside the US will be the ECB meeting, which starts on the 25th of Jan, this Thursday, and they deliver their update around lunchtime, Central European time. Fed policymakers are next week, and I think, looking at a diary, they can't comment this week. I'm pretty sure they're going to lockdown. There's no one in the actual diary. So what happened last week? What did cause that pushback? Well, we highlighted in last week's preview, Waller was first up, the hawk, and I mentioned it in the live show. He was pushing back from the 6 rate cuts being ridiculous, acknowledging that policy is tight, that they would go, but it'll be later in the year. Bostic back that up third quarter. Daily suggested they needed to be patient. So all week long they kept the same rhetoric, and they're all three of those are on the voting committee. So I keep going about it. They're not going to go too early because of their burns scare. They literally don't want their fingers burnt, but I think they've got the excuse to go at any time. And the biggest danger they've got at the moment is that we actually get this no landing scenario, and they've still got high rates that are unjustified by low inflation. They might actually get bluffed into going too early before things get difficult again, when they're not the greatest of timers, these people, as you can see from how long it took them to actually start putting the rates up. So it's a mixed bag. US election years are generally positive, not as much as the third year, but I keep saying it again, I think that will lead to us seeing a lot of the move in the first half, and then we'll start running into a few issues. But at the moment, you listen to commentary and it's all about the Magnificent Seven being ridiculous. Well, let's perhaps look at a market where we do get breadth and everyone else has to catch up. This reporting season, next few weeks in the US, will really drive that. The UK still has the hardest job. Mix of data last week was rubbish. CPI was up. Wages at best were okay, but they're elevated and sticky in that CPI services side. PPI, encouragingly, did show some weakness, and hopefully they follow through and flow through to the next few months. But retail sales were unexpectedly poor. There's not been a lot of commentary on it, and it is out there, but the stagflation mix for the UK is not great. It won't. I don't think that'll happen, but worst case scenario is they've got a mix of data that makes them have to hang on to the back end of the year. Hopefully they'll be in line with everyone else in the middle, but there's not a lot of actual decent data flow in the UK this week. It's just some marginal advanced PMIs, a bit of consumer confidence, fairly light. In the US, the data that came out, jobless claims really trended down again. That's hotter than people expected. We've got non-farm payrolls coming out in basically just under 2 weeks now, and a lot of the secondary evidence expectations are fully fed, and the Michigan surveys, they were both ahead. US retail sales slightly better. A lot of discounting was attributed to that, and gasoline came in quite cheap, so that gave a few extra cents in the pocket in the States. There might be a little bit of kickback next month when the Houthi strength comes through on the oil flick, but it's not really been anything to get too worried about so far on the gasoline side. But Friday, the markets were already quite exuberant, and it really got ignored a lot. The Michigan inflation expectation print was the lowest since early 2020 at 2.9, and all the expectation components within that were all very, very bullish. Home sales were flat, but again, as household inflation continues to drop throughout the year, people have more money to spend, a bit more confidence, so you'd expect those to pick up. Again, the US, week ahead, it's all about Friday, really. It's the PCE, the Fed's favourite measure of inflation. The headline one of that is already below 3%, and there's a good chance the core drops this week, and that just puts more pressure on that real rate differential. That will be, running at 3% versus a PCE, starting to get that semblance of being too tight. So it's really not a great deal in the States either. No commentary from the officials. You've got GDP coming in on Thursday. Now, the expectation I see here is 1.7, but I'd heard people whispering up to 2.4 on the back of the retail sales. So, if anything, look for that to firm up during the week. So, yeah, we said there's the ECB meeting on Thursday. That's the biggest thing in Europe. They've got year-on-year inflation pretty low. Again, it's all about when will they cut. And Lagarde was actually quite candid, almost saying that, there's lots of opinions amongst her officials, pretty much dependent on where they live. But the key from it is, she said they're going to be restricted for longer, but mainly because they don't want to waste the last 15 months of hard work. She said credibility matters. I did have to chuckle. But yeah, again, she was asked about the US election and had to take a pause and said, "Let me have some coffee." That's a tough one. I mean, the Europeans are worried about the inflationary impact of Trump, and the market heuristic, the thing that everyone's taking for granted, is that his import tax would be inflationary. Well, China are really struggling. They've got deflation in their system. I think, if anything, there's a risk that they take on that import tax and slash quite heavily on export prices. We'll see. So putting up imports could be just as deflationary as inflationary. Discuss. It's like being at school, isn't it? So net from everything she was saying, June, July looks like a classic for them to make their first cut. And I did this last year, and I'll do it again for future updates. We need a grid of when everybody's actually doing their meetings and decisions, because that actually is as important as the data. So once we've done June and July in the ECB, they're not back until mid-September. That'll be a big void over the summer, so they'll need to make a decision at the start of that period, I think. So on Thursday, they're meeting. You get the decision at 1:15 GMT, 14:15 Central European, and then half an hour later, they'll have a meeting. So that's not the only central bank doing anything this week. I was asked on the preamble to the live show, have I got any thoughts about the Bank of Japan? And they've got this week's Tuesday meeting to get through. And it is tricky. They've had 3 decades of being on this negative rate path. Can anyone actually out there remember? Are you old enough to remember when they had positive rates? I'd love this to all happen and unwind, but the timing is difficult, and it is difficult for them at the moment. They've had an earthquake, another one overnight, tsunami warnings, plane crashes. Would you want to be in charge of the Bank of Japan, being the first guy to put rates up in 3 decades? I think it's coming, but it's all really going to be about the commentary on Tuesday. And, are they moving more towards yield curve control, or any suggestion of when it would be prudent to move the rates? You always have to read between the lines with the Japanese. Ironically, everyone in the rest of the world, it wants inflation down. These guys want inflation to become sticky, but it depends what kind. They don't want cost push inflation. It's the old supply curve being tight. They want it to be genuine demand from investors and the public. So really, they need to see a bit of growth, wages coming through, prices going up, all in that growth wage price spiral, as they call it in economics. And March the 15th is quite interesting, because that's when they have their wage release. They release their wage data. We're looking for that to be over 4%, and that will be just before their March meeting. So they might not have enough time. So I think the market's moving towards a consensus of April being when things might start to happen. In the meantime, from everything I've presented, we should have a dollar sell-off coming there, which will have its effects on Japanese yen. So yet again, the things might be done for Ueda without him having to actually make a decision. So at the moment, people are talking about there might be some yen weakness, but unless that goes to 150, 155 region again, which is when they get a little bit twitchy, and they might have to start putting in some rate chatter. I think we are. I mean, it's a sort of sideways, and as we show the chart later, the kind of 1 to 2 year view for me is that we're in a consolidation period, and it's about to the US dollar, Japanese yen's about to sell off. So we're about to head into a positive yen environment, and it's all about getting the expectations of the public right. There's very few people, certainly not this latest young generation, that will have seen any inflation, so they're not going to be used to it. That's going to be a hard sell. So geopolitics still out there. Not really many headlines over the weekend, but that's going to continue to be dragged around. I think at some point, with the way that the oil market's set up, something will happen the other side of the Arabian Peninsula, just because they have to try and get some life back into the pricing. But it feels like the path of least resistance is up at the moment. People are walking the wall of worry. Nobody's really calling it, and you tend to see these things go against the consensual view, and it's like that. So be careful. This market could just keep rallying in the weeks ahead, and with that dollar sell-off support. Haven't heard Anyone talk about the wall of money for a while, but 8 trillion is in the background, and it won't take a lot to make that come out of the money funds. We're into earnings season. That could easily come in with a net reevaluation to the upside. We've got some big names coming out. Just look through the list in the preview. US could be very, very interesting this week. So time to look at the charts. I'm going to look at oil, the US indices, gold, the dollar, and then the dollar yen. Redhead asked all about the oil chart in the chat post the live show, and I think it's instructive to start with the long-term setup, the weekly chart. This is where we based the big sell-off that came from May 22 down into May, June last year, being the first leg. Since then, we've been pretty much consolidating. We put in a connector X into September highs, and then despite what anybody does, we look to be in the sell-off phase. But if you look, there's a lot of bunching going on the weekly basis. That looks like if we're doing this WXY 3 waves down, the waves within that, you'd expect an ABC. This first move down to the 70 level looks like an A. We're consolidating sideways, and then I expect another sell-off leg to complete it. Now, the equal legs, you're looking at it and thinking, wow, that's a long way to go. $30. You'd probably be expecting there to be some kind of global recession. Could still happen. But what the big surprise has been last year was it's not necessarily demand destruction. It's that post the Russian efforts, there's been a hell of a lot of supply globally. Come on, the US are running gangbusters, and it is really a supply story. There's an absolute glut. We've talked about the Saudi Arabians cutting their inventory levels. With everything that's been going on, you would fully expect this X connector to be a 1, 2, 3, an extension thing all the way up to anyway close to 100, just because, historically, if you'd have said you've got the 4 wars going on that we have, it'd have been through the moon, and yet you've thrown everything at it and it's going nowhere. So maybe we should look at this carrying on for a few weeks, if not months. We'll look at another chart in a minute, the shorter time frame. It does look like the dollar's stuck in an up $5. The oil's up $5, down $5 kind of range. So we might get a truncated 3 wave, in which case the spot 618 of wave 1 becomes important. And that looks interesting because it's here at 53.71, and there's a lot of chatter that if the oil gets below 60, you'll start to see some intervention and supply cuts coming into the system quite aggressively. So that if it's not the end, it'll certainly be a big pause on the way down. So keep it in that. So sideways for now, if you can call a plus or minus $5 range, which is what I'm showing here as being sideways. It's certainly good for trading. Keep your eyes on it. So the channel is showing 76 to 71. Equal legs just within the sell-offs that we've seen would get us up to this 78 level. So that's quite important. But if anything, to me, just looking at that instantly without labeling it up, it does look like we've got a lot of 3 waves going on, which instantly makes you start thinking of diagonals and triangles. So we'll need to see how this progresses. But at some point, that they normally end with a big break of the trend. So I'll be up and up. We need to keep an eye on it, but that certainly sets up for the continued downside, we think. So we'd expect the end of this pathway to be probably a break to the upside of the channel and then off. It's just a case of when. But play the ranges. There's enough safety within that channel to have some views, but keep it at the back of your mind that if the geopolitics unwinds, then there's not a lot of support in the mix there. So just highlighting in the you've got Russia, Ukraine, Hamas, Israel, Houthi, Iran, China, Taiwan, and then you've got a bit of Trumpsky protectionism in the background. What effect's that going to have? Everyone's starting to talk about we've got to take this seriously. Mercantilism, that's what he's proposing. All the policy is very much inward looking after the United States interests over everybody else. So, be a bit flippant there. You could take a flamethrower to this oil market and it would still peter out, which is a bit like my power supply last night. Stormisha, you cannot defeat my power bank. Where are we? Boom, the hourly charts. Yeah, we've done all that. So the US indices, they're all playing around with new highs at the end of last week. Potential for more breakout. Dollar strength at the moment might just keep us in consolidation patterns, but net, it's going to be difficult to keep a lid on this market. The way I'm starting off in the short term is looking at the relationships to the moves up. So the wave 1 on the Dow has got a smaller wave 3. So we talked about that on the NASDAQ last week, and we'll look at that again in a minute. But what that means is if this current wave continues breaking, these labels can't stay as they are. If we take out 42,692 on the Dow, that would make this wave here as being part of a bigger wave, because it would make the way we've got it labeled here, wave 3 cannot be the smallest in a 5-wave move up. So you have to keep an eye on all of those. This short term, though, could be doing a little double correction while the dollar is strengthening. But after that, I'd expect at least a move up here. And again, I've labeled it up as a 1-for-1 just so that we can see what that looks like. And 0.618 and 0.382 would be 2 good termination levels. So I think just for the sake of it, you tend to see big levels touched. Surely we get a 40,000 print on the Dow, even if it then comes into a consolidation back into here. What will be interesting is where we see the actual 4th wave finishing, because that, when it goes into consolidation, is normally a termination zone. And I do apologize if you're hearing some grunting there. One of my dogs has come in. I think they're tempted by the rocky road. So that's the Dow. NASDAQ again, and this has been tricky. The NASDAQ futures have been trading on their own path versus the CFDs for 6 months or so now, at least. And it makes it difficult to, this week we are actually trading the CFD. Now, I put in last week, there was a big level, again, similar to Dow, the third wave. Within this third wave, it's all invalid if 17,455.65, I've labeled it up here, gets taken out this morning and overnight. 17,455.4 or something came in. Yes, 17,455.65 is the high, 56.19 is the break level. We'll have a look before we leave at the live chart on NASDAQ just to see whether that has had any effect. In the meantime, we're either going to get a continuation breakout in the short term as that becomes an extending third wave. Eventually, there'll be some kind of pullback, and then another breakout as the dollar comes off to get to the ultimate high. So be very careful in the short term. You know, the numbers are big on the consolidation, but you know, if you try to short on Friday, I had a little mess around. Shorts just kept getting walked up. Had to leave it alone. The NASDAQ is, while the tech arena is doing what it's doing, it's not something to take on lightly. As I said, if I could get the music in the background, it would be Swing Out Sister at the moment for Breakouts Don't Stop to Ask. US 500, the S&P 500. Again, a new high on Friday. Hopefully you can see it on the chart. This blue line here is the percentage of S&P 500 stocks trading above its 50-day moving average. We talked about it at Christmas when it was up to 90 level as perhaps being a time when we get a sell-off, and we did get that little pullback. It was symptomatic with wave 4. Now, as that has receded last week, it hit a relative short period of only being at 70%, and then the market bounced off that with the TSMC and the read-through for the tech stocks. So that looks like pretty much, you know, good signal for a turnaround there. Just need to see how this plays out. All I've done here is just put in a normal fib extension based off a fictitious pullback. We'll move this around as we see this progress. But again, we're very close to important levels. 5,000 for the S&P, just just because it can. Keep an eye on all this. Pullbacks in the short term while the dollar picks out its top, but after that, we're going to go anti-consensual probably, and it's higher and higher. Gold again. That was asked, will it ever sell off? Well, it's very interesting, isn't it? I've talked here about beautiful fibbing, and we're going to do some whiteboard Wednesday, some little teachings, and I said one of those is going to be on Fibonacci, and it's as I said, it will be all about telling lies, not so much telling lies, but telling fibs, and that's pretty much the way some of these things trade. Commodities tend to love trading around fib levels. I've mentioned it before, and this 1 hour chart, we've played with it. It's got some lovely setups in there. When I put in the first wave of the latest move down from the 14th, we put in the extensions to see just where we could go, because it was going to be a third wave of a third wave down potentially, or certainly in the C leg. So the thirds of thirds are always powerful moves, so that's when the extension should be in there. I talked about the 1.618 previously. It may well be an important pausing level. It turned out to be. We went down to the next level, 2.618, and we bounced off that. And then, ironically, the inverse of some fibs have taken us back to where this turned round. So if you look at this whole move, it did to 2.618, and then it's retraced all the way back to the one move. So you can do a relationship there of 1.618 divided by 2.618, and do you know what that gets you? 0.618. All this beautiful symmetry of dividing fibs, and we're going to talk about that in that whiteboard Wednesday, because it's important not just to know what some of these absolute levels are, but their relationships between them. Square numbers come into it at times, but certainly the reciprocals and the golden ratio itself, 1.618, the one that you get when you see impulsive moves. If you divide the golden ratio into 1, you get 0.618, and vice versa. So it's all beautiful symmetry and a lot to keep an eye on. So again, I've put in a fib extension from this current 4 high to see what that suggests. And we've got some beautiful tying up in the original idea of 1 equals 1, level down in the 1920 levels, 19, 10, 20, but some of these 1.618, 1.786, 2.236, and 2 interesting fib levels, and they all tie up with this ultimate 6.857 extension from when we first set up the relationship of that wave 1 down there. It's all getting very technical, but what it really means is we've got a confluence, lots and lots of different fib levels all happening and suggesting 1920. We look like we're just about to come off again, and I think overnight we've actually dropped down to the 2020 level. We may well be about to put in this final leg, and it'll be quick. Just then, hopefully, once we've got that in, dollar off, it's all-time high time. So if you go early now, make sure you're aware there could be a 5% drop. But certainly get the spondulas ready for 1920. Boom, boom, boom. So we talked about that. I need to get an ACG sponsored mouse, because this one I've got is rubbish. Right, the dollar, we keep saying, where are we? You'll have seen this chart ad infinitum. We talked about equal legs, taking it ultimately down to 93 when we get the whole of this C leg in. But currently we're in a consolidation of the first move down. What is a likely retracement? Well, we put that in spot 382, and we had a little bit of hesitation there, holding around there, but I think spot 618 up here, which is 104.75, looks pretty interesting. And then of this ABC up, equal legs of the A gives 104.586. So again, powerful combination of where we expect the 2 to finish. Looks like we're on our way winding up there, so look out for a little bit of dollar strength this week, next week maybe, and then that hopefully has got the connector in, the 2-wave in, and it's off to the races time. This is why I keep mentioning this. This is the daily chart. And again, if we go down to the hour level, and in this latest conundrum, looks like we've got in the 1 and a 2 and a 3. We've gone sideways. This sideways, the final leg's normally a 5. At the moment, it's looking like we've done 3. There might be a little sell-off in the short term. That just takes us to the breakout highs at the moment we're talking about in the indices. Last push-up, is that enough for get a consolidation into the equities charts? And then it's the Daddy Boy 3 on the way down. So look out for that. So I put here in that range. Again, from the bottom of the A, B, and we're now in C. There are the extrapolations up there. Got an extrapolation of this here. So where 4 spot 236 of the 1 comes, it meets the equal legs of A, B, C. And it's also, if you look at that blue line there, that's a 61.8 degree replacement of the first wave move down, which you can see down here. So the retracement of that up there. So we've got 3 powerful areas of Fibonacci all in here in this 104.5 kind of range. So you've been warned. Get ready to sell. And then we've got the US dollar, Japanese yen. We're going to keep it very simple. We've talked about it above. Worth a look ahead of Tuesday's meeting. But if you're looking at this 1 week view, you couldn't have a better defined sideways consolidation pattern. We had a 1 down, connector back, and we're looking for some near term 2024 yen strength, change of tack. Let's have a beautiful big arrow, because I think take out the potential short term for the dollar strength until it tops out, getting us back into that conversation of 150. Is it time for some intervention? I think the Japanese will stand firm. They'll hold the bottle. They won't talk about it too much in the current climate. And then March, April, big turnaround. And then, we want to be trending that as a seller, the US dollar, Japanese yen, buy the yen. So I think those pictures say it all. As always, be careful out there, and we'll speak soon.